You know that feeling when you look at a price chart and it just seems like complete random chaos? Well, what if I told you there's a hidden blueprint behind all that noise? A simple, repeatable pattern that's actually driving pretty much every major market move. So let's get into it and uncover that exact blueprint step by step.
I mean, just take a look at these setups on the screen. We are talking about trades with rewards that are 8, 10, even 12 times bigger than the initial risk. Now, this isn't about trying to catch every tiny little wiggle in the market. Nope. This is about having a framework that's specifically designed to find these high-impact, high-probability moments. Let's break down the exact logic that powers trades just like these.
So, how in the world do we find them? Well, it all boils down to just two fundamental forces. Really, that's it. If you can understand these two ideas, you can understand the whole blueprint. It's all about direction and fuel. And here they are, market structure and liquidity. Think of it like this. Market structure tells you which way the car is pointed. That's the overall direction, right? But liquidity, that's the gas in the tank. The car isn't going anywhere significant without it. Every single major move is just the interplay between these two things.
Okay, first up, market structure. This is our compass. At its core, it answers the most basic but absolutely crucial question. Which way is the market actually trying to go? Are the buyers in control, or are the sellers dominating the field? We're not guessing here. The chart gives us really clear signals about the overall directional bias.
And this shows exactly how we read that direction. An uptrend is just a simple staircase pattern, right? Price makes a new high, pulls back to a higher low, then pushes up to make another higher high. And each time it breaks that previous high, we call that a break of structure, or BOS, and it just confirms the trend is still chugging along. A downtrend? You guessed it. The exact opposite, just a staircase heading down.
But of course, trends don't last forever. So what's the big warning sign? Well, in an uptrend, that last higher low, that's the critical line in the sand. If price breaks decisively below that level, what we call a break of structure in the other direction, that's a huge signal that the buying pressure is fading and sellers might be about to take over. It's our first big clue that the game might be changing.
Okay, so we've got direction down. Now let's talk about that second force, liquidity, the fuel. In the simplest terms, liquidity is just a big cluster of buy and sell orders. And without these orders, the market literally cannot move. It's like a car running on empty. For the market to make any kind of real significant move, it has to go where the fuel is. So where is all this fuel hiding? Well, in very predictable places. Just think about it for a second. Where do most traders place their stop-loss orders? You know, the orders that automatically close their trade if it goes against them. Right below recent lows if they're buying, and right above recent highs if they're selling. These areas become giant magnetic pools of orders, huge pools of liquidity.
And because the market needs this fuel, it will actively hunt for it. Look at this example right here. Price dips just below those equal lows, triggering all the stop-loss orders waiting there. A lot of people see this and call it a false breakout, but it's not false at all. It's functional. Price just went to the gas station, filled up the tank, and now it has the fuel it needs to reverse and go target the liquidity on the other side.
All right, we've covered direction and we've covered fuel. Now it's time for the aha moment. This is where we put the two pieces of the puzzle together and unlock the actual blueprint.
And here it is. This is the whole secret sauce right here on the screen. Our entire strategy is built on this simple formula. We take the main trend, that's our market structure, and we patiently wait for a move against the trend that grabs liquidity. When that fake out happens, we don't get scared, we get ready, because that's our signal to jump in the direction of the original dominant trend.
Okay, that's the theory. That's the big idea. But how does it actually look in practice? Let's get into the nitty-gritty with a step-by-step playbook to see how this builds into a solid plan. So for a long trade, when we're looking to buy, the playbook is just 4 simple steps. First, we confirm the market is in an uptrend, making those higher highs and higher lows. Second, we find exactly where that liquidity is building up below the current price. Third, we just wait. We patiently wait for the market to dip down and grab that fuel. And finally, once that grab happens, we define our entry zone.
And this diagram just lays it all out perfectly. Step 1, you see that clear uptrend. Step 2, price kind of consolidates, creating that pool of equal lows. That's our fuel. Step 3, bam, the sharp move down. That's the liquidity grab, the fake out. And step 4, as price moves back up, we look to get in right around that demand zone, that key area of buying interest where the whole move started.
Now let's see this on a real chart, because that's where it counts, right? Look here. Step 1, the uptrend is obvious. Then price ranges a bit, forming that beautiful liquidity pool at step 2. Then watch this sharp wick down at step 3, that's the grab. And right after, price comes back to the demand zone, giving us our entry at step 4 for an absolutely fantastic, high-reward move that continues the original trend. It's the playbook, plain as day.
And for selling, or going short, the playbook is the exact mirror image. It's the same logic just flipped on its head. First, we need a clear downtrend. Second, we spot the pool of liquidity resting above the market. Third, we wait for that little pop to the upside to grab the fuel. And finally, we define our entry zone to get back on board with that dominant downtrend.
The diagram for the short trade shows this beautifully. We've got our downtrend, the market creates a pool of equal highs, price briefly pops up to grab that liquidity, and then we're looking for our entry up in that supply zone, the area of selling pressure where the last big downward move came from, so we can ride the trend down. Same logic, just upside down.
And let's look at one more real-world example. We have a confirmed downtrend, and you can see this obvious pool of liquidity forming above those highs. Price then spikes up to trigger all those stops, grabbing the fuel, and it immediately reverses, giving us a perfect entry at the supply zone to capture that next big leg down. Beautiful.
So let's just pull back for a second and put all this together. This isn't just another strategy. It's a whole new framework. It's a simpler, more logical way to see what's really happening on the chart.
You can honestly boil down everything we've talked about to these 4 simple stages. First, what's the trend? Second, where's the liquidity pool? Third, watch for the grab. And fourth, get ready for the reversal. The biggest takeaway here is to combine the big picture, the market structure, with the catalyst, the liquidity grab. That is your edge.
So here's what I want you to do. Open up your favorite chart, any market, any time frame. First, just identify the main market structure. Are we trending up or are we trending down? Then just mark out the most obvious pools of liquidity, those clear highs and lows. And then just watch. See how price interacts with those levels. I promise you, you'll start seeing this blueprint everywhere.
The market isn't just random noise anymore. It's a map. It's a map of direction and a map of fuel. And now you have the blueprint to read that map. So the only question left is, where are you going to find it next?